Hi, I'm James Robinson, and this is my stock pick of the week. This is part 2 in my 5-part series on the company Cisco, symbol CSCO. This time we're going to talk about the company's operations, which I'll admit is the part of this company that's not its strongest part. However, it's still not bad, and we do have to talk about it because what I look at in terms of operations is how well the company delivers goods and services to their customers, how efficiently they do it, and how good they are at controlling costs. So one of the first things that I look at when I look at a company is the company's gross margins. And I talk about a little bit, one of the reasons that I do that is because gross margins allow a company to make mistakes. If a company has lots of gross margins, that means there's lots of difference between the cost of goods sold, between the price they're able to charge and the cost of goods sold, and that leaves them a lot of room to maneuver in terms of price. But there's also some other things that are happening with gross margins. One of the things that we're looking for, if you follow Warren Buffett, is you're looking for companies with what's called a durable competitive advantage. That means that this company has, for some reason, an ability to price its goods above and beyond the simple cost of production. So an example of that is Coca-Cola. Coca-Cola has a durable competitive advantage because when you go out to a restaurant, you're almost always going to get either Coke or Pepsi. You're never going to get Fanta or some third party. And that's called a consumer monopoly, right? The consumer is used to using that product, will order that product. And there's a number of kinds of products. Wrigley's Gum is another one of those companies. These companies, because they have a consumer advantage, a consumer monopoly, they're able to charge more for their goods and services than other companies are. And that ability to charge more provides all kinds of advantages for the stockholder. It means that the company can withhold or can better withstand inflation because they're going to be able to raise their prices at or above the rate of inflation. It also means that the company is less likely to have an upstart come in and overtake them. So gross margins are both a byproduct of that and an indicator or a symptom of that. If we look at companies and the companies have really high gross margins, we can assume it's not a commodity company, that it's a company that does have a consumer advantage. That's how it got the high gross margins. And as a result, the company, therefore, is somebody that's more desirable for us to invest in. So when you're looking at gross margins, once you understand that they're very important and that they're indicative of a bunch of things that we really look for in companies, you decide, well, what's the threshold? And for me, the threshold is really 40%. I like to see gross margins at 40% or higher. In unique cases, I might buy companies with lower gross margins, but generally speaking, most of the companies I buy are gross margins of 40% or higher. In this case, in the case of Cisco, the gross margins are consistently over 60%. So that's 50% better than I'm looking for, which is a really, really high gross margin, which is one of the things that leads me to believe Cisco has this durable competitive advantage, and it's a consumer monopoly, not a consumer not as defined by the average buyer, but a consumer defined as the companies that buy internet-related products. So for that reason, the gross margins for Cisco are really, really attractive, and they're attractive even though many of the things we're going to talk about today in terms of operations are really pretty average. The fact is they're still a very profitable company, even though their costs are average at best in terms of the way they control them, because they have such high gross margins to start with. So the next thing that I look at after gross margins, and believe it or not, I do actually look at this after gross margins, is earnings. I want to see how the company's earnings are. I want to see that they're growing, or they're at least very, very stable. Preferably they're growing over time. And I like to see earnings per share hopefully growing at a rate that's faster than the earnings. And that would lead me to understand that the company must be buying back shares. So one of the questions you might ask is, why would I look at gross margins before I look at earnings? And that's because not all earnings are the same. If a company, for example, look at Alcoa, which makes aluminum, or you look at a company that's an oil company, oftentimes when the market for their product is really hot, those companies have fantastic earnings because the commodity is so highly valued and sought after and typically in short supply for some reason. But that tends to be very short-lived, and over time, what will happen is those earnings will erode, and that happens, for example, what's happening with oil now. The price for oil is plummeted, so oil companies are losing money. So when I look at gross margins, you'll tend to see those gross margins going up and down with the cycles of the market. So if I look at gross margins, I'm able to identify, well, this is a commodity company. Whereas if I look at those earnings, the gross margins are relatively flat, or better yet, they're increasing, I'll say, well, this company must have this durable competitive advantage, because in the long run, even though there are market cycles, those cycles don't seem to impact this company as much. So that's why I look at gross margins first. Then I look at earnings. Now, when you look at the earnings for Cisco, with the exception of 2018, this company had great earnings. They've grown pretty dramatically since 2002, and they continue to grow. So this is a company that we're very interested in. We like the earnings. We like the earnings per share. And so we both like the gross margins and we like the earnings. So another way of saying the same thing is I look at net earnings as a percentage of revenue, and I like to see those numbers continuing to do well. I like to see them in the 20% range, gross earnings. Net earnings as a percentage of revenue. Now the difference between gross margins and net earnings is gross margins uses operating income and net earnings is the actual bottom line. And so net earnings is what percentage of every dollar do you make that makes it to the bottom line in terms of profits. I like to see about 20%, and for the most part, this company hovers right around that number. So it's okay, but again, the gross margins are spectacular for this company, and the net earnings are better than average, but not nearly as spectacular. When you look at those two, that's an indication that the company maybe doesn't control costs as well as we'd like. So the first thing that one of the things we always talk about, or I always talk about, are what I call the 5 taxes. I used to call it the 4 taxes, now it's the 5 taxes. The 5 taxes are things that a company has to spend money on to some degree, generally speaking, and what we want to know is how efficiently they do with those things relative to other companies. And oftentimes a company will have one category where it's relatively high, but sort of the other 3 or 4 tends to keep them under control. And Cisco doesn't do as good a job in that. The first thing we look at is selling and general administrative. Every company has selling and general administrative expense to some degree. And the good news is, since about 2010, as you can see, this company has been bringing that number down. And they're now in the top 25% of companies, so it's getting better and better. That's a strong indication that I like to see that. When we look at plants and equipment, the company isn't actually doing too badly in plants and equipment. They're not in the top 25% of companies, but they're not very far from the top 25% of companies. The only downside to that is that we've seen in 2018 and 19, those costs have gone up and not down. So they're a little higher than I'd like, and they're getting even higher relative to where I'd like to see it. And so obviously these are 2 indications of why we saw the net earnings not being where we want them relative to where the gross income is. And that's because these costs are just a little bit poorly managed, or at least this company isn't able to deliver their costs very well relative to the best companies that we look at. So inventories for this company are not bad. They've been very, very flat since 2009. And so I'm not going to say much negatively about them. This is a company that produces hardware, and so they will have inventory. And one of the things that you'll see here is that a significant number of companies, 30% of companies, have no inventory cost at all. If you're a service provider, or if you are like a software provider, for example, you tend to have almost no inventory. And so while that's great and you love those companies, not every company can do that. And not every company needs to have that to be competitive. The costs aren't out of control. Their inventory isn't ridiculous, and it's been very, very stable. But just the nature of their business requires them to have some inventory, and that's a cost that not all of its competitors in terms of the investment universe bear. So in terms of R&D, this company is very much like a pharmaceutical company or like Apple. They're a company which is selling technology. They're selling the fact that they're literally building better they're building better mousetraps every year. And as a result of building better mousetraps, they have to continue to invest money because all of their competitors are out there trying to do better things than them. So we like to see R&D in relation to gross profit. You can see that really since 2005, this number's been very, very constant. That's a very good sign. You're never going to get away with a tech company like this having some R&D costs. And so I want to recap. It's not that any of these costs are high. It's that none of these costs are controlled in a way which makes the company excellent. The selling and general administrative and plans and equipment, neither of those are great. Neither of them are horrible, but neither of them are great. Inventory and R&D, same thing. Neither of them are horrible, but none of them are great. Most companies have 1 or 2 areas where they do a great job, and then they're sort of average in the rest. So that's what leads this company to be doing a relatively poor job in terms of managing its costs. There's just no area that they're spectacular. So the next thing that I look at is my 5th tax. It is a cost that companies sort of set themselves up for voluntarily, and they could get rid of it, but it is a cost that they carry, and it's something they really can't not pay once it's an obligation, is interest payments. I look at interest payments first, interest expense in relation to operating income, and I like to ensure that the interest payments in relation to operating income are less than 15% of operating income. As long as they're below that number, I'm fine with it. And this company is well below that number. It's in the area of 5%. And again, this company, as you'll see later on the balance sheet, has done a great job of paying down debt. But the interest payments for this company would be a little troublesome in that they have gone up relatively every year since 2006. But that doesn't tell the whole story. When you look at the next slide, the other thing you throw into the equation is interest income. And you can see the company has more money in interest income than they have in interest expense. And the benefit of that is that they actually have negative interest expense when it's all added up. So even though they take on some debt and they have some interest expense, this company gets a 4 out of 4 because it is effectively earning money off of its finance operations versus having a debt service that it has to meet every year. So in terms of a summary of operations, I look for companies with a gross margin of at least 40%. This company's gross margins have consistently been north of 60%. That's excellent. I really like that. I've already talked about why I think gross margins are important. So that, by the way, is the kind of thing that gets me very interested in a company from the get-go. In terms of earnings, they've basically been an upward trend for the last 18 years. That's, again, very excellent. We like that. They had one really bad year in 2018, but other than that, they're very, very strong. The only reason this company is not a 5-star home run is that it's got relatively poor cost controls. And again, none of these costs are out of control. They're just none of them are spectacular. None of them are even great. And the result is that the aggregate of them is higher than we'd like. They're barely in the top 25% of companies in terms of selling and general administrative. And they're merely average in terms of plants and equipment. Inventory and R&D are also nothing special. The good news is the company has very little debt, or relatively little debt, especially relative to its cash. And therefore, they have low interest payments. And even more importantly, the interest income is more than offsetting interest expense. So the summary is when we talk about this company's dividends and the balance sheet, and we talk about this company's wealth creation, you're going to see this company's excellent in those areas, and it's very much something that's very investable. In this area, which is operations, which is not unimportant, the company is, sort of in my investment universe. It's good enough that I would look at it, but it's not great. And so you take the good with the bad. No company's perfect. And that's sort of what's happening with Cisco. So thank you very much for your time. If you've made it this far, I'd like to suggest that you follow me on Twitter. My handle is @robinsonstocks.com. And if you do follow me, the benefit of that is that I don't always have a chance to post on video when I buy or sell a stock, but I will always tweet when I buy or sell a stock in real time immediately after making the trade. So if you want to keep track of what I'm doing and figure out if you want to sell or buy what I'm selling or buying, the best place to do that is by following me on Twitter. These videos are made to explain why I've done what I've done, but to see what I do when I do it, the best place to find that is on Twitter.